Is it selling over for now?
Susan, good morning. Yeah, look, we think so. We've certainly taken the view that it's been a buy the dip strategy, and probably the market's got a little bit overdone on the European debt issue. But at the end of the day, the markets are what they are. Certainly 4,500 seems to be a reasonable support level for the market. And the background in particular for investors looking at Australia is that this earnings season that you've just talked about really is exceeding expectations, and earnings growth is going to be a continued driver for share price performance for us going into the rest of this year.
Now, Martin, a lot of this theory is based on the fact that you think commodity prices are going to rise from here based on the U.S. and the Asian recovery, even though China is tightening at this point. And as you mentioned, you pointed out those Eurozone concerns, which is shaking a lot of nerves for investors.
Yeah, look, we view what the Chinese are doing actually is very prudent. You know, it's much better to have a sustainable growth pattern out of China, sort of running at 9 or 10%, as against boom and bust type of scenario at 13. The big kicker for us is that the inventory cycle that's starting to really kick into the US will have some benefits there. This is going to be the biggest recovery in inventories in the last 30 years, and there's quite a large gap between new orders coming through in the US and their ability to supply those orders at this point in time. So our outlook for commodities still is pretty positive, particularly those bulks such as iron ore and coal.
Yeah, hence your recommendation on BHP and Rio Tinto, which you said to buy back in November. And these stocks have actually gained during this downturn. Let me just ask you, do you still have a high conviction for these two, even after their mixed report cards? Rio Tinto, some would say, actually disappointed the market.
Yeah, look, the conviction's still well and truly there, so much so that we've recently upgraded our valuation on BHP once again. You know, it's a company with very relatively low levels of debt, high levels of cash generation, clearly great exposures to those bulk commodities I mentioned, and copper, which we're very positive about as well. So, yes, our conviction's well and truly intact for both those diversified miners. A little less so for the pure plays, so we're certainly recommending clients to be holding overweight positions in BHP #1 and Rio #2.
Okay, well, let's talk about the share performance over the past 12 months for these two, because Rio Tinto has far and away beaten out BHP's performance. But then again, BHP wasn't hammered as much as Rio Tinto during the financial crisis. But in your view, Martin, I mean, which stock represents more upside potential? You pointed out BHP might be slightly ahead of Rio, though it seems like the upside potential amongst analysts and their target price for these two stocks, it looks like Rio has more potential here, possible gains of 20%. Compare that to BHP, maybe 14% upside from here.
Yeah, look, it's probably it's a bit marginal, really. I guess for investors, you know, if you're still a little skittish about concerns about what's the state of the global recovery or the pace of that global recovery, then it's probably a slightly safer bet to going with BHP in terms of its balance sheet. But look, both companies are extremely well managed. Balance sheet has improved dramatically for Rio. They've got the right exposures in terms of the Asia recovery and the US recovery as well. But we probably we'd still rank BHP #1 and Rio #2. But very happy to have both, because clearly there's some difference between the two in terms of their operational makeup.